Something happened in markets this week, and the headline you saw was probably wrong. Tech stocks sold off hard. The Nasdaq dropped sharply midweek. South Korea's KOSP fell. AI names gave back gains. The explanation everyone reached for was simple: quarter-end rebalancing, some profit taking, maybe geopolitical nerves. But there was a number hiding underneath all of that, a number that tells a completely different story. U.S. margin debt hit $1.42 trillion in May. That is a nominal all-time record. And the growth rate is what should stop you cold. Year-over-year margin debt growth recently crossed 50%. The last time it grew that fast was 2007. Let that land for a second. Because what happened after 2007 is not ancient history. It is one of the most important financial lessons of the last century. And right now, the same pattern is quietly reassembling itself. Let's start with the basics, because margin debt sounds complicated. It is actually a simple idea. When investors borrow money from their brokerage to buy stocks, that is margin debt. You put in $1. Your broker lends you another dollar. Now you control $2 of market exposure. If the stock goes up, your gains are doubled. If the stock goes down, your losses are doubled. And if it falls too far, the broker forces you to sell. That forced selling is called a margin call. And margin calls do not happen one at a time. They happen in waves. When prices drop, borrowers get forced out. That selling pushes prices lower, which triggers more margin calls, which triggers more selling. This is the mechanism underneath this week's tech sell-off. It was not just rebalancing. Some of it was deleveraging. Speculative positions being unwound under pressure. And $1.42 trillion in outstanding margin debt means the unwinding has not finished yet. Now here is where the 2007 comparison becomes important. The issue is never just the level of margin debt. It is how fast it grew. When margin debt grows slowly over years, the system absorbs it. When it grows 50% in 12 months, that is a different situation entirely. It means a large number of investors borrowed aggressively in a short window. They were not building positions carefully, they were chasing momentum, and when momentum reverses, they all reach for the exit at the same time. In 2007, margin debt growth crossed the 50% threshold in mid-year. By late 2007, the market began its significant decline. The borrowers who bought on leverage near the top experienced losses that were not just painful, they were account-ending, because leverage works against you just as powerfully as it works for you. Now compare that to today. The S&P 500 has been on one of the strongest runs in recent memory. Tech stocks carried the index higher for 3 straight months. AI names posted extraordinary gains, and all along the way, margin debt was quietly expanding behind the scenes. This week's sell-off may have shaken some of that leverage loose. Charles Schwab's derivatives research team noted the drop likely wrung some of the speculative excess out of the system. But they were also clear about something. It is too early to say whether a sufficient washout has occurred. That phrase matters. A sufficient washout means enough forced selling has already happened that the system can stabilize. If it has not happened yet, there is more selling potential still sitting in the market, and that becomes relevant when the next catalyst arrives. Which brings us to this week's most important upcoming event. Thursday's June non-farm payrolls report. That report lands a day earlier than usual this week. Markets close Friday for Independence Day. Jobs data has consistently moved markets in 2026. The May report doubled expectations and flipped interest rate expectations almost overnight. If Thursday's data surprises again, either direction, the level of margin debt in the system amplifies whatever that reaction is. More good news could push leveraged positions higher very fast. Disappointing data could accelerate exactly the kind of selling we saw this week. If you find this kind of market analysis useful, consider subscribing for more practical financial insights. The context behind price movements matters more than the movements themselves. So what does all of this mean if you are not a trader? If you are just a regular investor trying to build wealth over time? Here is the honest answer. You do not need to panic, but you do need to understand what environment you are operating in. High leverage periods in markets historically produce higher volatility, not necessarily crashes, but sharper swings in both directions, and those swings can shake people into making costly decisions at the worst moments. There is a practical framework that works in high leverage environments. It is not complicated. First, know your own exposure. If you are holding individual stocks that have run up significantly, understand that a 15% correction in an over-leveraged market is not unusual. It does not mean the story is over, but it does mean you should not be shocked by the move. Second, Avoid adding leverage to your own positions during periods like this. Margin debt at record highs is precisely the wrong time to start borrowing to invest. You would be joining a crowded trade at the most vulnerable moment in its cycle. Third, use volatility as a tool rather than a threat. High leverage washouts historically create brief windows where strong assets get sold, not because they are broken, but because leveraged investors needed cash quickly. Those moments are the ones long-term investors can step into carefully. The broader backdrop this week was not all warning signals. PCE inflation came in roughly as expected. Oil prices dropped substantially over recent weeks, which is giving the Fed more room to be patient. The supercore inflation measure, which strips out housing and energy, is running at 3.9% annually. That is still elevated but not spiraling. PMI data for both manufacturing and services showed strength. First quarter GDP was revised up to 2.1%. Second quarter growth is tracking around 2.5%. The underlying economy is not broken. What is stretched is the speculative layer sitting on top of it. That is an important distinction. A healthy economy with overextended market leverage is not the same as a collapsing economy. But it does mean the path through this period requires more awareness than most investors are currently bringing to it. Treasury yields moved this week too. Two-year yields dropped around 9 basis points compared to last Friday. The 10-year pulled back 8 basis points. Falling yields alongside a tech sell-off and margin deleveraging is a combination worth watching carefully as Thursday's jobs data approaches. Here's the bottom line from everything this week revealed. $1.42 trillion in margin debt at a 50% growth rate is not a headline. It is a structural condition. It shapes how markets move. It shapes how fast sell-offs accelerate. And it shapes who gets hurt most when the unwinding comes. The people who understand this context tend to stay calmer during volatility. They do not sell in panic. They do not buy recklessly at the highs. They recognize that speculative cycles always correct eventually, and they position themselves to still be standing when the dust settles. That is not pessimism. That is just financial awareness. The market moves fast in moments like this. Stay grounded in the numbers that actually matter.